Hey, what's going on, everybody? It's Friday, yeah. You happy like me when it's Friday? All right. Plus, we had a really good day today. Very good day, but I want to tell everybody to just, stay even keeled. Don't get too excited. First, let me go back and tell you, 2 weeks ago, I said that last week was going to be your opportunity to buy low at the bottom. And that's how it's playing out. And the reason I said that is because I anticipated that we would see the end of what was really kind of a brutal 2.5-month period of sizable, significant tax-related liquidity drains. All right, this is a theme I've been harping on now, or explaining to you guys for the past couple of months. So we had the April tax filings. That was 323 billion. Government ran a surplus in April. That surplus ran into almost half of May. Okay, so that's a drain. That's a swimming pool. That's the water going out of the pool at the bottom. There was no water. When they're running a surplus, the government's pool has water in it. Ours has nothing. So that was literally all the water taken out of the pool. Then from May 13th until from May 16th till from May 16th on, we started to build back the deficit, the budget deficit. That's the water coming back in the pool. And then we reached on, June 10th, we reached a maximum height. The deficit was 164 billion. So we went from a negative almost 400 billion to 164. And that's great. That added the liquidity. The market started to stabilize. But then we've had, since then, continuation of these. Yesterday, I just checked again yesterday on the most recent data from the daily treasury statement, another drain of 11 billion. So it looked like, when I made my video yesterday, I said it looked like we were in the clear and things starting to slowly come back to a positive liquidity flow. Boom, we get hit yesterday with a net 11, it was about 11.5 billion drain. So the deficit fell to 48, I think it's like 48.5 billion. It's still a deficit, but that's small, okay? Again, the water level in the pool is down. I was talking about making a comparison where Lake Mead, where like every week it's going down by dozens of yards. Really incredible what's going on in Lake Mead, and that supplies so much water to the Southwest, not to mention the Hoover Dam, electricity. Just as a side note, I heard just yesterday that the level in Lake Mead is it's not a dead pool. It's the terminology is what just becomes before a dead pool. In other words, it's too low now to generate electricity at the generators at the Hoover Dam. Incredible. Vegas relies on that electricity. Los Angeles relies on that electricity. Anyway, let's get back to the market. Yesterday another net drain. So this great day we had today. Now I still anticipate, as I've been saying every day, a slowly recovering market and economy. But man, it's going to be real slow. I would not be surprised to see next week, Monday or Tuesday, a pullback from what we had today, okay? As long as these drains continue, maybe one day addition, one day drain, we're not really going to make too much progress. And until these positive liquidity flows become a steady phenomenon, in other words, when they're adding flow every day, adding net flow every day, we're just not going to really make much progress at all. But I have to say this. What will offset the shrinkage in the federal deficit is the non-government, the private sector, the economy, going into greater debt. In other words, they are going to be the net spenders. Now, you might say, that's no good. How is that good for the non-government to go into greater debt? And I would say, well, I kind of agree with you. It's much better if the government is the net spender because it doesn't add any liability to the non-government, right? If you get a Social Security check or if you get whatever, unemployment benefits, that's your money to keep. It doesn't come with an offsetting liability. But when you borrow or when a company borrows, yeah, it gets more money in its checking account, but that comes with a corresponding liability or a debt that has to be paid off. Now, the good news, as I've been telling you, is that household debt service burdens are at low levels. This is important because this would be really the main constraint on household borrowing. And that also applies to non-financial business debt service burdens. They're still low, okay? I'm not talking about the nominal or the outstanding level of debt. That's at a record, but it all comes down to, can you service this debt? How burdensome is, the process of making your payments? And if the debt burden, if the difficulty is relatively low, then things are okay for now. I mean, this obviously can't go on forever because you're going to reach a point like we did in 2006, 2007, where debt service burdens reached an all-time high, and then it was like a shaky house of cards, all right? But we're not at that level yet. The other thing that's going to help with credit creation or lending will be when the Fed really gets going with its quantitative, tightening. It's not really a tightening, as I've been explaining. They're going to, it's basically the economy gets more government securities and less reserve assets. But look, as I've been telling you guys, I mean, this week we had again a record amount of deposits shifted into the reverse repo facility. I mean, the banks, they don't want these reserves. They don't need these reserves. And every time they pile up in the system, they get shunted off to the reverse repo facility. And, the Fed had to create this because of its own rules. All right, all these reserves put the banks in jeopardy of violating leverage ratios. So, I mean, rather than change their regulatory structure, the Fed created this new facility so that the banks can just, put these reserves into that facility. It's a crazy setup. I've said this so many times, but who am I? I mean, I don't make policy. I mean, this is what they do. So let me sum it up for you. We're still in I don't say we're in a net drain situation, but we're in a stagnant situation. The pool level is like less than halfway filled, maybe a third of the way filled, and it's just sitting there. I mean, it's literally, we're like Lake Mead right now and the Hoover Dam. I mean, you can't generate a lot of power with the level at where it is right now. And unfortunately, I check this stuff every day looking for some consistency in the growth in these liquidity flows, but it's just not happening. So when you get a day like today, which was a fantastic market move higher, it's great. But then be prepared for some give back next week. Unless we see let me restate, unless we see these fiscal flows now become sustained in a positive fashion, like every day, we're just going to have this kind of difficult back and forth type of market action. It may be frustrating to a lot of you. Again, I'm going to say that over the next 3 months, July, August, mid-September, 2.5 months, it should be positive on balance. I mean, it'll be positive until we get to mid-September, where we're going to have another quarterly corporate tax payment. But it's going to be positive in an incremental way. All right? An incremental way. Look, 48 billion deficit for the month. If you think about it, I mean, we were running 300, almost 300 billion deficits regularly like last year. So I mean, do the math. We were doing like 250 billion a month average last year. I mean, do the math. And now we're doing like 50 billion, maybe 80 or 90 billion once in a while if we're lucky. So I mean, the flow has really, really been reduced. And it's going to manifest in a, it's kind of choppy market action, but it will creep higher. And so I'll repeat what I said yesterday in my video, that the strategy continues to be buying dips. And above all, you got to have patience. You got to have patience. And when you get a day like today with a big up move, just mentally prepare yourself that we're going to have some corrective price action following this move. I mean, that's just how it's going to play out. I don't know how I could be more specific than that. I think I'm giving you, an absolutely concise outline of how this market trade is going to evolve over the next couple of months. Anyway, that's it for today, folks. Have a great weekend. I'll see you. Bye.